And we talk about this, and yet I don't think we really look at it carefully enough. For example, hedge funds only report their returns typically monthly or sometimes only quarterly, and so you tend to sort of assume that whatever they're giving you is an alpha. However, if you did a correlation or a regression of those returns on some just basic factors, what you find in your average hedge fund is a significant amount of their variance can be explained by common factors. So in my opinion, the liquidity, transparency, and fees need to be separated for alpha and beta. If it's truly alpha, if you can show that it's not related to other broad-based factors that you see in the marketplace or risk premium, then you should pay a high fee for that. And by the way, you probably shouldn't expect a lot of transparency. If there's real skill there, it shouldn't be transparent. On the other hand, if it's much more like beta, or if it's entirely beta or some kind of exotic beta, then you should expect transparency and liquidity. So in summary, I think you need to separate the noise from the information, and there's a lot of information that can be gained by just looking at the relationship between broad market indexes.
And just as a quick follow-up, do you think that who is going to help investors, or do investors have the skill to do that level of analysis essentially on a fund, to understand the differences between systematic exposures to common variables and true skill? How is that going to happen, and how are folks going to identify those differences, do you think?
I was hoping you guys would do that at Capital IQ.
We'll try.
No, I mean, I think, honestly, I think the consultants largely do it, but I think the clients don't really engage in that kind of conversation. And so I'm not sure that even if the clients have the information, it's discussed in that way. Having said that, if most clients are looking at their performance for the last couple of years and seeing the extremely strong correlation performance across their so-called alternative managers, they're probably much more open to having the conversation today about what are the risk factors embedded in your manager. So I think the data's kind of already there. It's just sort of getting the dialogue. And maybe a better question for Jaeson, because I'm sure that comes up all the time in NEPC, to sort of ask, how engaged are clients in those kind of conversations.
Sure. Thanks. Michael.
Yeah, for the life of me, I don't understand how 2 and 20 with no hurdle or preferred return became the norm. So it does seem to be changing. There should be hurdles, an appropriate hurdle to the strategy. There should be some clawback, but even on a more sophisticated basis, like Mark says here, it really absolutely should be that way. Now, what I'm about to say is not very politically correct, but with regard to transparency, I'm glad to hear what Mark said, because this whole thing about transparency is way overblown. Everyone wants 100% transparency, if not tick by tick. It's totally ridiculous. People wouldn't know what to do with it if they got it. If they did do something, they'd probably do something stupid. If they didn't do something, are they liable? Because there's a pension plan a $7 billion pension plan that asked, they got every position in their portfolio, and it was 27,000 pages, not items, pages. Another pension plan asked Lehman for all its derivative positions. There was 1 million pages. All right, people, once you get it, it's already history. The manager's always thinking. So it's ridiculous. And like Mark said, if you have a great manager who really does have a proprietary strategy and edge, it behooves everyone not to get that out. That manager, on the other hand, you can get all the transparency you need to manage your risk and to figure out, monitor that manager and to aggregate, all your managers and figure out your aggregate risk in ways that don't threaten that at all. You can get all the transparency you need. So this thing about transparency is really, in my opinion, way overblown. But get some. I mean,
it's probably ill-defined as well. Just for the record, I don't think all hedge fund managers lie. The problem is 97% of them give the rest a bad name. So when I look at these things, I think, and this is something that I was talking about back in the early 2000s, when more and more say pension plans started getting involved in hedge funds. if you don't know what a manager does, and it's hard to go from long only to long plus short plus derivatives plus all kinds of other things, I think the first thing you look at is performance, and you start trying to make some sense of that. And I apologize for all of you who've heard me say this, but past performance for me is indicative of past performance. It gives you some idea of what the manager's done over time, but I don't think you can extrapolate in a very fast-moving portfolio that's long and short, a lot of different things, over time what that manager can do. So you've got to understand what he owns. And I equate it to looking at a speedometer, goes 400 miles an hour, and you get really excited and you buy the vehicle and you find out it's a minivan. What I think you should do first is understand the vehicle. So if it's I don't know, some of these, a Testarossa maybe will go 400 miles an hour. You look at it, you understand the chassis, the engine, the body, everything else. Then you look at the speedometer, and if it goes up to 400, that might make a little more sense. It's about triangulating. As far as liquidity, fees, and transparency, let me just focus on transparency here, and what Michael said is, I agree 100%. There are a couple things going on. If you have transparency, meaning the manager is giving you all the positions, he could be putting himself, and you have to presume that you're not special and he's giving it to everybody else. So you have his book out there. A lot of things can happen, short squeezes, all kinds of things. But you also put yourself in a liability position, because if something blows up and you show up and you say, well, I had all the, somehow they'll find out you had all the information, you go to the end of the line. So what you want to do is understand the portfolio, what the manager does, what he's got in the book. I often sit down with managers and look at their book at their place, they're in their offices, just to understand what's going on. But you have to, I think you have to me, the transparency part is validating what you understand about the strategy. And then the performance is another, say, piece of the mosaic that you're putting together that'll validate what the manager says. So if he says he's short tech and tech rallies tremendously and he shows a positive return, I think Michael Berger did that back in '99. You just know that that doesn't make a lot of sense. So the one thing at Anderson we would always ask is, does this make sense? Keep yourself out of a lot of trouble if you ask that question, and answer it the right way.
Sure. Thank you. So let's talk for a moment about the regulatory environment. A lot of pressure, both political and for investors, for additional regulation of hedge funds. First up, do you see that happening? If so, how? And really, what is that going to mean for both new and existing funds in light of some of these potential structural changes? Start with David again.
Again, we have a few incentive fee-based partnerships, but not a lot of them, and so my comments will relate to what the regulators do with our business, which mostly come out of the investment company division. But we had an examiner. We had an exam about 18 months ago, and the examiner was a real hard ass, and made life very difficult for us. That examiner has subsequently left the SEC and is now in the private sector working for our auditor, which was a nice move for us. So we went and met with him now that he works for us, and I very much enjoyed interrogating him, and found that he remains quite a difficult personality, but it's much better when you're paying them than actually having to report to them. And what I found is that they are going to, just continue their scrutiny and work in different ways post Madoff in terms of really carefully examining affiliations, and also issues like insider trading, like just stretching the definition of what insider trading is well beyond even our wildest imaginations. And I think, in the coming months, we're going to see a real trend with the regulators in terms of coming in and scrutinizing things. So to the point about transparency and giving a portfolio, I mean, some of the things they've said where, a pension plan may say to you, hedge fund, well, we're not giving you any money this year because our pension fund is not funding any contributions anymore, but they haven't put that in their K yet. That information could be contrived as inside information, and if they end up executing a transaction on that particular security because of what they heard as a client or as a manager of that client, that could become